Okay, well, hello everyone. I'm James Harte and welcome to this Orbex education session. Now, in the last few sessions, we've looked mainly at the use of technical indicators and how you can use indicators to inform you on the movements of price with respect to elements such as volatility, momentum, etc. And we've looked at how you can use this information to build trading ideas and identify trading opportunities. Now, in this session, we're going to do away with the indicators and focus purely on the price action itself. Now, as ever, if anyone has any questions during the session, please just type them in the chat function and I'll try and stop periodically to answer them, and then we'll also wrap up with some questions at the end. So let's kick off first of all then with what do we mean when we talk about price action? So when we talk about price action, when we focus on price action, we are studying the historical, recent and current movement of price to gain an understanding of how an instrument behaves, seeking to identify patterns and sequences that tend to yield specific results, with a view to taking advantage of future instances of these patterns. Now, you might hear the term price action bandied around quite a lot, and I guess for new traders it can be a little confusing because different people can mean different things when they're talking about price action, but generally price action simply refers to the study of charts without the use of technical indicators. That's it. So whether we're talking about trend lines and channels, support and resistance, or chart patterns and candlestick, it's all just price action. Now, for some people, trading without the use of different indicators and the array of signals that they provide might seem quite daunting. And indeed, once you start to study price action and the various chart patterns and candlesticks that there are, it might start to look even more daunting with such a huge range of various patterns to focus on. Excuse me. Now, price action is actually at the core of my own trading, and I've gone through the process of learning what works for me. And so in this session, instead of just giving you a brief overview of the various patterns out there, we're going to focus on just a handful of patterns and price action setups that can really work well in your trading. And as ever, we're going to keep things nice and simple and straightforward in these sessions. And I reiterate, if you have any questions, please do just write them in the chat function. So to kick things off then, the first structure that we are going to look at is the falling wedge. Now, the falling wedge, which you can see here, I've drawn beautifully for you. The falling wedge is a classic chart pattern that remains one of the most popular patterns among price action traders, as it can often yield powerful breakouts. Now, the falling wedge is a bullish pattern and it's formed here by converging trend lines. So this zigzag formation is meant to represent price, and then these are the two converging trend lines which we use to highlight the pattern. Now, you'll notice that the upper trend line, the resistance trend line, tends to have a steeper gradient than the lower trend line. And the reason for this is that buyers are stepping in earlier on each descent. Okay, so each time that price sells off within this structure, buyers are stepping in earlier on each descent, and sellers are failing to drive price meaningfully lower. Okay, and this is the basis behind the pattern. Again, it's used as a bullish reversal pattern precisely because of this information. So in the same way that we can use indicators to get information on price movement, we can actually gain this information just from studying the actual movement of price itself. So in this scenario, the contracting range shows that momentum is waning in the market. So sellers are losing momentum, they're failing to drive price meaningfully lower. And at the same time, the flatter gradient of the supporting trend line shows that buyers are stepping in earlier each time, and this alerts us to the possibility of a reversal. Now, we identify a bullish reversal as a breakout above that trend line resistance. So this is what we're looking for when we trade this pattern, okay? So we identify these converging trend lines and this narrowing range, and we anticipate the price is going to break out above that trend line resistance. Now, when it comes down to how we actually trade the pattern, we have two options really. One is the aggressive approach, whereby we simply enter long as price breaks out above that trend line resistance. And then the more conservative approach is where we wait to enter long on a candle close. So we wait for a candle to close above that trend line resistance before executing any positions. Now, I prefer to stick to the more conservative approach because oftentimes when traders adopt the more aggressive approach of simply entering as price breaks out above that trend line, you will tend to find that you get whipsawed a lot on false breakouts. And so waiting for a candle close just adds a little bit more confirmation that the breakout is valid, okay? Obviously price can still reverse, nothing's set in stone, but waiting for that extra confirmation can be a really good filter to help you avoid some unnecessary losses. So once we've entered long on the move, once price has broken out above that resistance trend line and we've entered long, our stop needs to go a little bit below the low of the structure, okay? Because we need to allow enough room for price to roll over if needs be, to correct a bit and retest that structure, okay? Now if our stops are too tight, then all that's going to happen many times is that price is simply going to have a shallow reversal, take us out as it retests that broken structure before reversing and going on to target. So for that reason, stops always need to go just a little bit below the low of the structure. So once we've entered the trade, then once we've gone long on the breakout, our basic target is a retest of the top of the structure, okay? So whilst indeed this is a bullish pattern and we are looking for a breakout, you will often find that price retests the top of the falling wedge structure only to then reverse, okay? And this can often catch a lot of traders off guard. So depending on how you trade, you should look to either exit the full position as price retests the top of the structure, look to trail your stops up higher as price retests the top of the structure, or look to take some of your position off, again, depending on your own individual trade management strategy. But the key point here is that the top of the structure represents a key price pivot. And so really you need to be adjusting your position, you need to be adjusting your trade management in some respect to reflect the significance of this price level, okay? Because as I say, oftentimes price will trade up to the top of the structure only to then reverse. Now, the caveat to this is where the actual size of the structure negates targeting the top of the structure, okay? And let me explain this a little bit more clearly. You can see here that we have quite a deep structure, okay? So the distance from the top of the structure to the bottom is fairly sizable. And so depending on where we're able to enter, if we're able to enter in the lower third of this range, then we have a good 2-to-1 return on our trade. Now, if we had a more shallow structure, a flatter structure, then we'd be entering somewhere in the middle of the range, and this would negate our entry point, okay, because our risk reward would be compromised at this point. So in terms of how we look to trade the position once we've entered, this really depends on the size of the structure and the market conditions. If we have a flatter structure, then it makes sense to look to hold the trade beyond the top of the structure. And so in that respect, we might simply look to move our stop to break even to protect ourselves against any adverse price movement from that point. However, where we have quite a deep structure like we do here, then it makes sense to simply bank once we've got a good return to risk. So if we hit a 2 or 3-to-1 return to risk at the top of the structure, then it really does make more sense to exit the trade at that point than to simply hold the trade longer. So this is the pattern and the basic way in which we can look to trade it. Now, one key thing to remember with this pattern, and really with all pattern trading, and this is integral to successful pattern trading, is that you really need to consider the location of your patterns. And with a lot of the new traders that I work with, this is one of the big challenges that a lot of them have. You see, I don't just trade every pattern that sets up blindly. Location is the most important aspect when I'm trading patterns. And so generally, with falling wedges, my preferred setup is to see a falling wedge at a retest of key support. And the reason for this goes back to what I was saying about how we can use chart patterns to gain information on the market. So for example, once I've highlighted a key support area in the market where I anticipate we will see strong demand drive price back up, and I'm expecting I'll be able to enter a long position, I want to look for evidence that a reversal is likely to happen. And knowing that the falling wedge is a bullish reversal pattern showing that waning bearish momentum and building aggression on the buy side, then where I can identify a falling wedge pattern into key support, this validates my thesis, okay? So if I identify an area of support where I'm looking to get long, the presence of a falling wedge pattern at that location confirms my bias and therefore allows me to enter the long trade. So let's take a look at an example of a falling wedge on the charts, okay? So you can see here we have a really good example of what we've just been talking about. You can see we have our two converging trend lines, okay, showing that contracting range, showing that waning bearish momentum and that building bullish pressure. Again, you can note that the resistance trend line is steeper than the supporting trend line, reflecting the fact that buyers are stepping in earlier each time and sellers are failing to drive price meaningfully lower. So you can see we break out above the resistance line at this area here. Again, we wait for our candle close. We go long on the candle close once price is broken out above that bearish resistance line. And then again, in terms of our stop placement, we need to make sure that our stop goes in below the low of the structure. And as we talked about with that basic diagram in terms of giving the trade room to move, you can see here how price reacts once it breaks out above that bearish resistance line. So you can see we break out initially, we fall back and we actually retest that broken bearish resistance line before the market then recalibrates and we take off and trade up to target. Okay? Now you will often find this occurring with these patterns. Once we get that initial breakout, price oftentimes will come back to retest that broken trend line. And depending on how that retest occurs, and depending on what your own trading preferences are, this can actually represent a good opportunity to enter the trade. Indeed, for traders who don't like to play breakouts, okay, for traders who prefer to play a reversal, then one of the ways which you can look to approach this pattern is waiting for price to break out above that resistance trend line, waiting for it to then come back down and retest, okay? Now in this instance, the retest has come very early in the move, and so it's a little bit too messy to play a retest. However, if price had broken out more significantly initially and then retraced, it would give us more of a clean retest, allowing us to enter. But the key point here again comes down to stop placement and making sure that your stop is below the low of that structure to allow the market room to retest once the breakout has occurred. And one of the big mistakes that a lot of new traders make when they're trading these patterns is in moving their stops too early. Okay, so a lot of traders like to move their stop to break even as early as possible to get a so-called risk-free trade. However, what you need to understand is the dynamic of how price moves when it breaks out of these patterns, okay? So these patterns represent a compression in volatility in the market. And once volatility returns to the market and price comes out of this structure, there is very often a retest of the breakout zone due to the shift in underlying order flow. And so although on the surface moving to break even early seems like a good move and seems like you're taking some risk off the table, what you're actually doing is sabotaging your chances of success in terms of trading the pattern. Okay, so the inverse then to the falling wedge. So the falling wedge is a bullish reversal pattern. The bearish reversal pattern is the rising wedge. So the rising wedge is just the exact opposite of what we've been discussing with the falling wedge. You can see here that this time we have our converging pattern, our converging trend lines rather, showing a contracting bullish range. So price is moving higher and the contracting range reflects waning bullish momentum and building bearish pressure. And so again, this time the upper trend line has the flatter gradient, showing that sellers are stepping in earlier each time as buyers lose momentum and fail to drive price meaningfully higher. So again, the trade protocol around how we approach this pattern is simply the opposite of what we discussed with the falling wedge. So we enter short as price breaks down through the supporting trend line, and our stop needs to go above the top of the structure, again to allow for that retest. And so we enter short as price breaks down through that supporting trend line, and we're targeting a move back down to the bottom of the structure. So again, simply the exact opposite to what we discussed with the falling wedge. And also the entry mechanism is exactly the same. We're looking to use the conservative approach where we wait for a candle to close outside of the trend line, outside of the supporting trend line, and then we're short on a break from that trend, that candle low. Okay, so those are the wedges, and again, these are fantastic structures to trade, and they typically precede big moves in the market. Okay, as we talked about, the structure essentially highlights a compression in the market, and the subsequent return of volatility can present a very profitable opportunity. And if we think about the actual information that we're getting from price here, and if we think about the context in which this could be particularly useful, is where we have a trending market. So we have a bearish reversal pattern here. We've got our rising wedge. Now let's imagine that before this pattern formed, we had a large sustained sell-off in the market, giving us a really clear bearish trend. We then get a brief correction higher, and we see this rising wedge pattern form, and we know what it's telling us about waning bullish pressure, waning bullish momentum. And so we're simply waiting for bearish momentum to take over again and for the trend to resume. So this can be a fantastic way to take advantage of corrections in trending markets. Now the next price action structure that we're going to look at is the head and shoulders pattern, okay? And this is another key pattern that I monitor the markets for. And a lot of you are probably already aware of this pattern, but for those of you who aren't, this is the basic structure of the pattern, okay? This is a bearish reversal pattern, and it consists of 4 reference points that all need to be in place to successfully classify the head and shoulders structure, okay? So we have our left shoulder here, a head here, a right shoulder, and then the neckline. And you can see quite clearly now where this pattern derives its name from, okay? So very basic structure, but the reason why this pattern tends to work so well is because of the underlying order flow dynamic at play, okay, which represents a clear shift in market sentiment. So we have the left shoulder representing an initial test of highs whereby sellers step in to drive price back down. So we come back down towards the start of that initial move, which is the neckline area. From here, however, buyers once again step into the market and drive price back up. And this time, we actually break out above that initial high. So we erode the orders at that initial high. We drive higher. However, after forming a new high, sellers once again step back in and drive price lower. And where do they drive price back down to? They drive price back down to this neckline area where we know there is good demand in the market, okay? So buyers step back in here at our demand zone at the neckline, drive price back up. However, this time, instead of making a new high, instead of even getting as high as the current high, we only make it up as high as the initial high, okay? As high as that left shoulder before sellers once again step in and drive price back down. And then what we're looking for to confirm the pattern is a break of this neckline area, okay? So we're looking for supply to outweigh demand at this area, push the price down through the neckline, blowing buyers out of the water and confirming the shift in sentiment, okay? So a very basic pattern, but again, giving us really key information about what is happening with the underlying price flow. And so where we see these patterns forming at the end of trends, these can be a very clear sign that the market is likely or vulnerable to undergo a significant correction or reversal. And again, the location of the pattern is key. I don't just look to trade this pattern because it pops up, okay? I don't look at my charts, identify a head and shoulders pattern and simply enter short. I'm looking to identify these patterns at predetermined locations where I expect there to be decent resistance. Okay, so I'm looking to identify bearish reversal patterns at key resistance levels, and I'm looking to identify bullish reversal patterns at key support levels. So here is a chart example then of the pattern. So you can see here again, although this is slightly messier, and this is one of the things you will often find with the patterns in practice, is that the actual identification of them can be a little messy. But again, you just need to refer to that basic structure. We have our initial high, a higher high, and then a third high in line with that initial high. So this gives us our left shoulder, our head, our right shoulder, and then we have our neckline. Now another key thing to point out here is that you'll notice that the neckline is sloping here, okay? We haven't got a perfectly horizontal neckline, and oftentimes the neckline won't be, okay? It can be sloping upward and it can be sloping downward, but the pattern is still valid. And this is where it really comes down to spending some time building your competence in identifying these patterns, because it's one thing simply drawing diagrams of these patterns and learning the textbook theory around them, but you really need to apply some time to get really good at identifying these patterns as they form on the charts. Now the basic strategy for trading the pattern is quite simple, and you can see that I've identified these trade management points on the chart to make this clear. So essentially we look to enter short on a breakdown below the neckline, and as we talked about with the wedges, the way that I personally look to enter these trades is to wait for a candle close, and this is the more conservative approach. Again, if we're simply looking to enter as price pierces the neckline, then oftentimes you can leave yourself vulnerable to a false breakdown. So for as much as possible, look to wait for a candle close below the neckline before going short. So we go short once price has confirmed a break of that neckline, and then our stop goes above the right shoulder, okay? Now there are some traders who will place their stop above the actual head of the pattern. However, I prefer to place my stop above that right shoulder. Placing the stop above the head simply gives unnecessary risk on the trade, okay? Because oftentimes, if price reverses to break above that right shoulder, typically it's going to break out above the head as well. So the right shoulder is a solid location to put your stop above. And then the basic target for the pattern is simply to aim for multiplier of risk, so to aim for 2 to 1. Okay, so in this instance we're simply targeting twice our initial risk on the trade. So you can see here price breaks down through the neckline, we get in short on that candle close below the neckline, and then look what happens, look how price reacts on that initial breakdown. So we sell off initially, however, instead of moving down to target in a straight line, you can see we actually start to get some chop and some kickback from price. So you can see that price reverses from that point, trades back up, and actually breaks back up above the neckline, okay? So we trade back up and break above the neckline, however, we don't go as high as the right shoulder, and so our stop remains intact, okay? And again, as we talked about with the wedges, one of the ways that a lot of traders can look to utilize these patterns is to actually trade the retest of the neckline. Now in this instance you can see that price has broken back above the neckline. In many instances price will simply return to the neckline, will get a brief pause before price then continues to sell off in the direction that we originally anticipated. So depending on how you like to trade, you can either trade the initial breakdown or you can wait to trade a retest of the neckline. Obviously, the retest of the neckline isn't always going to occur. So you need to bear that in mind when you're deciding how it is that you want to trade this pattern. So once price is broken back above the neckline then, in line with our bearish bias that's indicated by the presence of the pattern, you can see that price then once again reverses and sells off. However, before we make our way down to target, you can see that we actually trade back up to retest that neckline a further time, okay? Again, highlighting the importance of these breakout areas in the market. These are key areas of shifting order flow, okay, where we've had a supply-demand imbalance shift in the market, and price very often likes to return to these areas. So, having tested the broken neckline for a second time, price then reverses and sells off, and we hit our target. Okay, so this is the basic way in which we look to use this pattern. And as I say, location is key. So if we can identify a head and shoulders pattern at a retest of prior broken support, then this is a good area to look to sell. If we can identify a head and shoulders pattern at a double top location, then this is a good area to sell. Okay, so always be thinking about the location before you're thinking about the pattern. The presence of the pattern means nothing unless it's in the right location. Okay, so, and as with the wedges then, we also have the bullish version of this pattern, which is very appropriately called the inverse head and shoulders. So going straight to a chart example then, because I'm sure now that you're quite comfortable with the parameters of the head and shoulder pattern. So you can see that we have here a really neat inverse head and shoulders pattern. Again, everything is simply the opposite to what we just discussed with the bearish version of the pattern. So in this instance, you can see price comes down, forms our left shoulder, trades back up to the neckline, reverses and sells off, trades down to form a head, so this is our new low, trades back up towards that neckline, comes back down, but only makes it down as far as the initial low. So we've got our left shoulder, our head, our right shoulder, and then we're looking to play a breakout above that neckline. So in this instance, you can see that price broke out above the neckline at this point here. Again, we wait to enter our trade only when price has closed above the neckline, okay? So remember, this is the bullish version of the pattern. We're waiting for price to close above the neckline. And then again, look how price reacts once it breaks out from the neckline. We don't just trade straight up to target. We get an initial breakout, price reverses, trades back down, retests that broken neckline. We move higher, come back down, retest it again. We take off significantly at this point, but then yet again, we come all the way back down and retest that broken neckline and actually make our way a little bit below it here. But again, we don't come anywhere near as far as our stop. And from this point, price then reverses and takes off and trades up to meet our target. And again, as we talked about, this breaking out and retesting of the neckline really is a key element of how you both enter and manage these trades, okay? Because as we mentioned before, if you're simply moving your stop to break even, once price has moved even a small part of the way towards your target, although it might feel like you're being conservative and protecting yourself, taking some risk off the table, what you aren't doing is actually displaying an understanding of how price works and how these patterns tend to work. You need to give price some room to retest these breakout areas, okay? And often, as we can see here, it can take several retests of the breakout zone before price finally trades on way to target. And so if you're moving your stop to break even too early, you're simply going to get shaken out and you're going to end up missing out on a lot of winning trades and sabotaging your long-term performance. So sticking with head and shoulders then, starting to think a bit about candlesticks then, one of the ways in which I also look to trade head and shoulders patterns, which is a slightly more aggressive approach, is where I look to trade the potential right shoulder. So I look to anticipate the formation of a head and shoulders pattern based on the presence of a left shoulder and a head. And then what I'm looking for is price to move up to around the level where the right shoulder should be, and then I'm looking to identify a bearish reversal candlestick to confirm to me that this is likely to be a head and shoulders pattern, and I can go ahead and get short, okay? So this is the key element to this trade. I reiterate, I don't simply trade the level, okay? So for example here, where we have our left shoulder, our head, and our right shoulder, I wouldn't simply get long just because price trades back down into the area of that right shoulder. I'd be looking for a bullish candlestick, a bullish reversal candlestick in this instance. So going back to the actual classic version of the head and shoulders then, and the candlestick which I like to use most is a bearish pin bar, okay? So for me to enter this trade, what I'm looking for is price to move up to the same level as the left shoulder, where I anticipate, okay, this could be a head and shoulders pattern. We've got our left shoulder, we've got our head, we've got our clear neckline here. So if price moves up to the same area as that left shoulder, and I identify a bearish reversal candle, then I'm going to go ahead and take the trade, anticipating the price is going to sell off, and we're going to see the formation of a head and shoulders pattern. So again, it's a slightly riskier entry, it's more aggressive, the pattern hasn't been confirmed, I'm anticipating the presence of the pattern. However, obviously, when we enter at this point, we actually greatly reduce our risk. And this is what makes the trade so favorable, because we're getting in much closer to the top of the pattern, and so our risk reward is amplified, okay? So this is a great example of where I combine candlesticks with price action. I'm highlighting a potential reversal area as indicated by the pattern, and then I'm using a key reversal candle that I know tends to precede reversals when in the right location. So this really shows how I can gain information on the market and form trading ideas almost at a granular level, okay? I'm identifying a key structural level that I'm anticipating will see a reversal in price. I'm identifying a reversal pattern at that location, which I know indicates the waning of momentum into the level and a shift in the supply-demand sentiment in the market. And then I'm finally using a precise candlestick which represents an acute shift in market sentiment, in this case the pin bar, to enter as a leading indicator for the bigger reversal that I anticipate will occur. So again, I'm looking to identify a bearish pin bar at the site of where the right shoulder should be, and then I'm looking to trade to the short side. And the beauty with entering at this point, okay, really is the fact that when we usually enter on a break of the neckline and our stop has to go above the right shoulder, depending on the size of the pattern, our stop can be quite significant. However, where we're able to enter up here at the right shoulder and we can put our stop above the head of the pattern, then we don't even need to wait for price to break the neckline. We don't have to hold this and play it in the same way that we would a conventional head and shoulders trade. We can simply target and move down to the neckline. And you can see here, this is a perfect example of where that can be really useful, because there are many times when price won't break the neckline, and so we have our head and shoulders pattern, and either price will fail to break the neckline and take off, or worse still, it will break the neckline, trigger us in short, and then take off, okay? So where we get the opportunity to front run the pattern and trade short from the right shoulder, then this can be a really fantastic trade to take. Now when it comes to using candlesticks then, as well as the pin bar candle, another candlestick, or candlestick formation rather, that I like to use in my trading and analysis is the inside bar, okay? So this is the inside bar formation. It's very basic. We have the presence of a first candle, a larger candle, which we call the mother candle, and then we also have the presence of an inside bar, so a candle that forms completely within the range of the first candle. And essentially this formation signals to us that there has been a contraction in the market, okay? So we've made a directional move to give us our first candle. Let's imagine this first candle is a bearish candle. So we've had this sharp sell-off, we've got our bearish momentum in the market, but then the next candle has failed to display a continuation of that momentum, and we've actually seen a contraction in the market and a fall in volatility, okay? Because the next candle has formed entirely within the range of that first candle. Now, once we identify this pattern, this should alert us to the possibility of a continuation in the market, okay? So again, imagining this is a bearish candle, we then get a slight pause in volatility. So what are we expecting or anticipating is going to happen next or at some point soon? We're expecting that the market is going to roll over and we're going to get a candle break to the downside. So essentially, I like to use inside bar formations as an alert to a possible continuation move in the market. So I look for price to make a move based on a breakout from a pattern or a reversal from a level, and then I look for momentum to stall, and I look for that brief consolidation in the market before giving us an inside bar formation, which I can then use as my entry point, anticipating that the initial move is going to continue. So again, where this would be a bearish candle, then my entry point is simply going to be below that candle low, and my stop will be above that candle high. Now, where this is a bullish candle, where the first candle is a bullish candle, my entry point is above the high of the candle, and my stop is below the low of the candle. So let's look at an example of how I use this formation in conjunction with a classic chart pattern. So here we have EuroCAD on the daily time frame, and you can see that we have a really nice head and shoulders pattern formation, clearly defined here. Again, we have our left shoulder, or an initial high. Price breaks out above to form a new high, giving us our head. Price then retreats, trades back down to the neckline, trades back up, and only makes it as far as that initial high, giving us our right shoulder, giving us our head and shoulders formation. We then wait for price to break down below the neckline, giving us our bearish signal. However, this time we aren't simply going to enter short as price breaks down below the neckline. We're going to wait for the presence of inside bars in the market to confirm a pause in momentum, a contraction in volatility, and then look to enter once those inside bars break down. And you can see here highlighted in this blue square, we get our initial breakdown candle here, we then get another bearish candle here, but then look what happens. We actually get two candles here which form inside that initial candle. So just really focusing on what the price action is telling us here, we've had an initial surge in bearish momentum. We've then had a pause, okay? Price has failed to continue the bearish momentum that took it down through the break of the neckline. Price pauses, we get this contraction in volatility, and we anticipate, okay? We anticipate that what we're going to see is a continuation of the bearish momentum, which is indicated by the breaking of the neckline of the head and shoulders pattern, okay? The head and shoulders pattern, again, bearish reversal pattern. We've had our initial breakdown. There is bearish momentum in the market, but momentum pauses. We get this contraction, which we can capitalize on, okay? So once we identify this contraction, we're then simply looking to sell on a break below the inside bar lows, and that's what we get here. You can see price then takes off and sells off. So this can be a fantastic way, just as we talked about with trading the pin bar at the right shoulder, this can be another fantastic way to combine price action patterns and candlestick formations to identify trading opportunities and to form biases in the market and enter trading positions. Okay, so that's been quite a dense session. We've covered quite a lot there, and I really hope that you found this session useful. Again, price action is at the very core of my own trading, and I'm very passionate about it and enjoy discussing these price action patterns and candlesticks with you. And I hope that you found that session engaging and that you're looking forward to applying these ideas and some of the structures and formations that we've given to the market yourselves, okay? And again, as I said earlier, the idea with these sessions is that we give you a really solid foundation in the various areas that we cover. Not just a brief overview or some superficial insight, but some real practical working knowledge that you can take away and begin implementing yourself. And then if you find the content interesting and useful, obviously this will spur you to dig deeper and to continue to study and research on the subject. So again, thank you everyone for joining me today, and I hope you found that session engaging and useful, and I look forward to catching up with you all next time. Brilliant, thank you. Yeah, this will be uploaded and released to everyone who has subscribed for the session. Thanks a lot for all your comments and your feedback, guys. That's very kind. And yeah, look forward to catching up with you all next time. All the best now. Cheers.